Hey traders, Raghee here. Welcome to Charts and Coffee. Happy Thursday, everybody. Hope everyone's doing well. All right, so let's get to it. A couple things to kick off this particular episode, this session. And the first is, really doing a little bit of a deep dive into the anatomy of distribution. Now, the difficulty in the market that we have right now is that we haven't settled quite into distribution, and probably, well, anyone who's looked at the Russell nearly throughout 2021 will see that they know what distribution is. This is what distribution looks like. This is actually a very prolonged distribution. So distribution isn't something that, especially if you've been looking at the Russell, that you should be in any way, unaware of or unfamiliar with. So there is that possibility. Sorry, I just put my watch on for the morning. It's amazing how when you have a watch on your wrist, you don't stare at your phone quite as much. It's an interesting phenomenon I have noticed. So I've got my got the watch. Don't look at the phone. It's amazing. Anyway, all right. So if I'm taking a look at what's going on in terms of the market behavior on the Russell, this could be one scenario that we see going into later this year. Now, a lot of folks will ask, is this a bounce we sell? Is this a rip we sell into? And that all has to do with whether or not, by way of the tools you use, and of course the variance in the market in terms of opinion and action, boil down to what kind of tools each one of us use on a regular basis. So if your tools say, yes, this is overbought, slow stochastic, ready, aim, fire, I'll use the V score. If your tool says, yes, this is a peaky level, I don't believe it is, not yet, then yeah, you might have the beginnings of a short sell. If not, remember that, take a look at the IWM just to balance out this sort of overwhelming expectation of the break of the previous trend is somehow this absolutely clear harbinger to a downtrend. It's simply not, and the IWM really reminds us of that. So the characteristics of distribution start off as a broken uptrend. And then we start to look at the two scenarios that could come from that. Distribution, which is higher probability, or potentially turning into a downtrend. This being October, of course, the bearishness is probably what is clearly most dominant. In some ways, it does have its root in 1987. I mean, that's where we can talk about the foundation of the psychology. It's 87. So do we want to keep running the same pattern, same psychological pattern of 87, or are we just going to trade what we see? I'm going to choose to go with the latter. So with that being said, this was actually going to be probably the first time that I go into a webinar and teaching a class where I get to deep dive the fact that choppy markets are pretty tradable. Right. Those of you that have looked at some of the free videos and the commentary that we've had on the Russell, you know that levels like this are extremely fadeable once you've got the distribution set. So choppy markets are absolutely tradable, but it's that segue out of the trend and then into whatever the next market behavior is going to be that is so trying. And it does last, a brief period of time. And we're still in the middle of that mosh pit. Right. Okay. So that's what's going on here on my end, and then things that are typical to Thursday. Of course, today's sort of an early start day because we have here we go. We have the claims numbers, the unemployment claims numbers, and then 10 minutes later, Williams spoke. So we're going to take a look at the culmination of what pre-market unemployment claims and Williams did to psychology. I don't really see anything that I'm terribly concerned about with that 1-2 punch of data and the FOMC chuckleheads. So, looking at what's going on the S&P, what do you want to look at? What happened at 8:30 and then what happened post 8:40? So here's your 8:30 response, which was fairly muted. And then 8:40, well, I think some of this is probably a little bit of Williams. So keep that in mind. This is what we're inheriting going into the US Open. All right, so let's get to the questions. And first up is, all right, let's see. Do I short the Nasdaq after a big bounce? Only if it's a downtrend, my friend. No, I don't see a short pattern. Not for me. Then again, please remember, I'm not bearish. So the environment dictates the strategies. The environment dictates the direction. So I'm not bearish. So consequently, unless we're talking about intraday, which, yeah, I'm open to shorts. But end of day, longer term, overnight, I don't have the environment that would allow me to consider shorting as a viable option. And by the way, that is by design. If through your process, whatever it may be, if through your process, you're not whittling away from the different choices, if by your process, you're not sort of pouring all the ideas into a filter only to be left with fewer things to consider, for most traders, the process unfortunately becomes a megaphone. They start off with a small idea, and boom, it kind of goes into many different, larger, more ideas. We want the opposite. We want to filter lots of ideas being whittled down into a few concentrated strategies that are appropriate for the environment. So that's what my process is designed to do. I do not have, it's eliminated for now. Now, if you ask me about the XLI, different question. Please don't feel that the strongest index or the stronger sectors are where we want to go do battle for shorts. It's very much looking at the markets and asking what is already wobbly, not going, look, I'm not looking for a knockout in the first round, right? Looking for a knockout maybe in the sixth round. So what sector, what index is kind of wobbly on the sixth round? If you're a boxing fan, once a fighter breathing with their mouth open, that's when you're going to get the knockout. That's XLI. And that's where I'll look at the structure of double red to give me a market that looks like it's already, some of the heavy lifting in terms of the weaknesses has been done for me. And by the way, if you haven't checked out the webinar, if you weren't able to join us live, and by the way, thank you for those of you that were with me live yesterday. You can check out the webinar replay over at simplertrading.com/trend. And then if you want to check out what we're doing with the class, that's at simplertrading.com/extract, as in extracting profits from the market. So yeah, if you didn't check out the webinar live yesterday, the replay is posted over at simplertrading.com/trend. All right. So, and then this is the date for the class. And here is the replay. I get this question quite a bit after a webinar. So there you go. Okay. So let's get into the next question. And that's mRNA. All right. So yeah, let's take a look at mRNA. Is on my short list. Okay, so I love the idea of having a watch list for buys and a watch list for shorts. No, I cannot put this on the short list. Weakness does not automatically mean I've got a bearish market. There's too many things here that are telling me this is neutral and potentially oversold. Now, I think, the cool thing is I know that not too long ago, preceding the class that I'm doing right now, or I'm going to be doing on the 16th, we had our big Ready Aim Fire launch. I know a lot of you are armed with Ready Aim Fire. And if you're looking for an environment that I feel is really absolutely ideally suited, it's the right club for the shot, it's chop, it's distribution, it's a yellow underlying JT multi reading that tells us that overbought, oversold is the way in which we look at the market. That's the language of this market right now. It's not by the dip. And I think sell the rip is only in very small corners of the market. So it's not broad, the sell the rip sort of language. The language that I'm looking at the market through is the language of overbought, oversold. That's the language of distribution. So that's where I would be looking at. Now, could you short a rip? If there's a level to think about doing that, again, ideally not something I want to do because I don't have a downtrend. But if we close the gap, if we end up closing that gap that occurred on the 1st, so we gap down on the 1st, and you take a look at the close on the 30th, that could be an interesting close. Getting up there, point of control, gap close, closing that window on that significant gap. If you're looking to fade strength, aka short, that might be a really good level to do that, Richard. So thanks for the question. All right, next up. Hey there, Melissa. I really enjoyed the webinar last night. So pleased. Yeah, and again, you can catch that replay over at simpletrading.com/trend. And, we're going to have another one next week. So you know how this goes. We talked about dips and a bit about the tools. And then, what I'm going to be talking about next week is going to be a little bit more oriented to chop, right? Because the idea that there are not dips to be bought in this market is actually categorically untrue. There are dips to be bought. There are corners of the market that are still double green by the dip. I had 2 of them in Tesla in September. We've been doing that in Natty Gas for weeks. But then there are corners of the market that are going into chop. So we're going to talk more about that next week. So, and then all of that is going to culminate into the class on next Saturday. So thanks. I appreciate that. Is Natty Gas on the radar? It absolutely is. So if you look at Natty Gas futures, big sell-off. Now, if I have a sell-off that exceeds the typical price movement range, the historical volatility for a particular market, in this case, we're talking about Natty Gas. If I have a singular session that just absolutely crushes what we typically see as a range, then I want to remember that it makes sense to, well, A, anticipate possibly a lower low, minor low, or B, the potential for a harami, inside candle, inside day, call it whatever you want. You can call it a ham sandwich, as long as you understand what we're looking for. So yes, while Natty Gas sold off yesterday, because once we exceed 0.22 in terms of that move, we have to wait. And we have to wait for that entry that shows us that we're stalling, that there's confirmation that the buyers went, oh, wait a minute, this looks kind of interesting. This might be a time to start pricing out calls or start building a long position. So that's what we'll start looking at today. What pattern we end up with is probably going to be our very next setup. Yeah, I agree, Anthony, and UNG. So thanks for the question. All right, moving on. And yeah, Stephen, same thing. I love that you all are asking about Natty. I'm super, super impressed because, look, I think there's a lot of traders that see the weakness and think, oh, is this a market to short? No way. It's just that the dip was really very violent, historically far bigger than normal moves, and patience, but bullishness, I think, is really where we want to sit at the moment. So love it, love it, love it. Do we have gap psychology in play today? So, Tony, I'm looking at a gap from 2 perspectives. One perspective is a gap from, sort of the more vanilla, sort of more more widely accepted gap. That is, are we below the previous session's close or above the previous session's close? So where are we in that regard? The next part of understanding a gap is, kind of more probably something that's in the jargon for traders who use market profile. And that is a true gap. That's the way I've always been taught what that is. That's the way I've always heard the lingo. A true gap, which is not just opening beyond the close, whether it be above or below, but also the high or the low. In this case, yes, right? Which means that I will be acutely aware of A, wanting to be bullish, but B, maybe if we get it, and I sure hope we do, we'll be ready for it. Can we get an early morning after the bell fade. Short sellers coming in, fading the strength. If we can get that, we might get a nice V-score low buy, HPMR low buy for an intraday trade. And I'll be in the futures room here in about 4 minutes to take y'all through looking at some day trades. We did the same thing in the Sector Secrets Mastery yesterday. We day traded the morning. What a great morning that was. Probably my best morning of day trading and probably one of my more active mornings of day trading this week. So yeah, we're going to be looking for possibly some gap up V-score fades. So yes, is the answer on if we have gap psychology in play. Yeah, take a look at the S&P. Here is the NAS. Yeah, Yahtzee, right? So keep that in mind. Another thing that I would definitely do, and if this were double red, we'd be shorting. Since it's not, this is just going to potentially be a fatigue area. But we'll see how this session continues, because we've kicked the can on the debt ceiling. So that's one less thing for the market to worry about near term. And, probably a pretty big reason why we're strong. But I think another thing to note, especially for those of you that are future traders and understand the 24-hour nature of the markets, well, we did not get that really disappointing risk aversion move with the London Open, because we've been seeing a lot of difficult data for the UK economy the last week or so. And we've been inheriting oftentimes a weak Asian close and a weak bearish European, more so UK Open. Did not have that today. So very interesting to see that we didn't have that early morning 3 a.m. sell-off. All right. So thanks. I appreciate all the, thanks so much for the feedback. Now, we're going to, again, we always have 2 webinars before the class. And, next week, a lot of folks are curious. Okay, Rog, we get that you can buy dips, superpower. We got it. But what about the market that we're venturing into now, right? Yes, there are corners of the market that are dip buyable and cool. We understand what's going on there. But what if we go into chop? What if you go into a downtrend? And, what is that going to look and feel like? And where are the opportunities in that kind of situation? So, yeah, looking forward to, talking about those topics next week. All right. So next question is, what do I think of Tilray? I'll tell you what, straight up, I haven't looked at that in a really long time. Let's take a peek. All right. I think it's one heck of a downtrend. I love that you asked this question. I love that it's a downtrend. But see, so, the fear is, and by the way, if the majority of the conversations that are being had on financial media, on the interweb, generally speaking, if the most common, persistent conversation about the markets is we're going to crash, newsflash, we're not going to. Markets don't sell off when everyone's talking about a sell-off. Think about the sentiment the week before the Evergrande move. Everyone wasn't talking about it's time to move lower. Remember, crashes come more as a surprise. So the more that we're talking about it, and the reason that is because we as a trading and investing public, we discount what we think the most likely scenario for the market is. But by discount, I mean we look at our data, indicators, fundamentals, whatever the mechanics are for our decision-making process. If that keeps indicating bearishness, then that's going to reflect in the kind of positions that we take. So it's being systematically discounted. So that's why when we talk about certain things, it's in some way, to some degree, already baked into the cake, which is why they say, big sell-offs, crashes, these things don't happen when we're talking about it. Those sudden moves. It's what surprises us. All of a sudden, after months of concern, 2 Mondays ago, Evergrande ends up being the thing that suddenly, at that moment, the markets were completely horrified about. So these things usually catch us by surprise. But if we end up in a downtrend, and this is a pretty shallow one, but if we end up in a downtrend, this is what it looks like. And this is the environment. So for those of you wondering, okay, Rog, I saw the indicators you used. Can it prepare me for a downtrend? Double red, short the rip, short the rip, short the rip. You see what I'm saying? So it's kind of the smile turned upside down, where you've got a double green, buy the dip, double red, short the rip. And it's all anchored in an understanding of the environment, which is why I keep saying I cannot, because my tools, I trust my gauges, right? They always say, trust your gauges, right? I trust my gauges. I cannot short this yet, because I don't have the proper environment for it, right? Now, if we get to the top of the range around 45, 45, 45, 50, I'll be talking a very different tune, singing a different tune, because at that point we're arguably overbought. Okay, but and we could all probably make that same argument around 44.75. That we could potentially be overbought. That's when Ready Aim Fire, Slow Stochastic, V Score, Darvis. That's when we say, okay, we're in chop. The language of chop is overbought, oversold, not buy the dip, not sell the rip. Are there shorts to be had? Yes, but they're not trend following in nature. Hope that helps. It's a tricky time. It's really important to not beat yourself up right now, to not be trading too actively. It's a tricky time. With that being said, I got to head on over to the futures room. I will see you all tomorrow, same time, same station. I am in the futures room for the open, and then I'll see you all in the options room for our 30-minute little lightning round session between 1:30 and 2 Eastern. All right. Be good to each other.